Hello, my name is Mark Griffith. This is a very brief introduction to an extremely important instrument, the stop order. It doesn't matter what you're buying or selling. They could be shares, they could be bonds, they could be ounces of gold, they could be bushels of wheat, other kinds of commodities, currencies and so on. If you're doing it through a broker, you can give the broker what is called a stop order. Now, what that means is that's an order to close out your position. So let's imagine you've bought 3 lots. Each lot represents $1 million worth of British pounds, for example. And you're hoping that the object that you bought is going to go up in value and that you're going to make a profit. However, it might go down in value and you might make a loss. There are 2 kinds of stops, and the loss stop is the more important one. What that says is that you want to close out your position and make only a certain loss. So if you buy gold at $900 an ounce, you might give your broker a loss stop order at $890, which says that if the price falls to $890, the broker should sell back your position so that you are out of the market. And of course you'll have taken a loss. But this is to protect you, because if you just kept onto your position and it fell through 890, 880, 870, 860, you could make a very, very large loss. So the loss stop is to limit your loss. Profit stop, pretty obviously, is a way of getting out of the market and taking a profit. So you might buy something and you might give the broker a loss stop and a profit stop order, so that the broker knows that if you start losing money, he can stop it by activating the loss stop when it gets to the price you've specified. And if things go well and you make money, then you hit the profit stop and the position is squared out at the profit stop. And the one last thing to keep in mind is that obviously you want your loss stop to be closer than your profit stop. There's no point losing $20, making $20, losing $20, making $20, losing $20. You want to run your profits and cut your losses. And that means that if you buy, as in my example, if you buy gold at 900, you might have your loss stop at 890 or 895, but you might have your profit stop at 915 or 920. Which means that even if things on average every second day move up or move down or go against you or go with you, you will be making more money than you lose if you can consistently set the profit stop further away than the loss stop. Good luck, be careful.